Good morning. Today is Monday, February 13th. Get those flowers because Valentine's Day is tomorrow. Tomorrow we have a big day. Tomorrow we have a lot of news coming out. We have the consumer price inflation data, which we're going to talk a little bit more in detail toward the end of this call. We have the NFIB small business optimism, Eurozone GDP, our second look at that. So it shouldn't be too market moving. We also have Coca-Cola earnings. So tomorrow is going to be a very big day. Plus you got Valentine's Day on top of that. But let's first talk about consumer spending because it has picked up. It did pick up in January rather significantly. This was due to three reasons. Number one, you had a weak December. So when you take the month over month change and you seasonally adjust that, you're comping over a period of December, which was rather weak. And that was weak for a couple of reasons. Number one, there was bad weather. And number two, you had a much more front-loaded holiday shopping season in October and the first half of November than you've had historically. And so that helped to cause a little bit of a weaker December as well. So that's number one. Number two is that you have larger post-holiday clearance sales. And we've seen that, I think, when we've gone to the store, there do seem to be some more deals if you know where to look. And then number three, and this is probably the most interesting, perhaps the most significant, you do actually have an improvement in disposable personal income just because you're turning the calendar. So what happens is the cost of a living adjustments for Social Security recipients changes at the beginning of the year, and it changes indexed to inflation. And so this is supposed to be just a cost of living adjustment, nothing more than that. But it's 8.7% this year because inflation was so high. So this is really tantamount to a significant raise for a lot of Social Security recipients, and that is helping to raise disposable personal income. In fact, if you just take that alone, that 8.7% growth alone, that's going to raise overall nationwide disposable personal income by 0.5% for January. So essentially, you have more income, more money to spend, and people are spending it. And we're seeing them spend throughout the economy.
I mean, there is definitely a concern there that, basically if you're on Social Security and that's your only form of income, you were behind the eight ball for the entire year with inflation. Suddenly you get a raise, but inflation is coming down. I mean, that could be a recipe for reacceleration, which I think the bond market is signaling that we're probably going to see a reacceleration in the CPI report. We've seen a pretty strong sell-off on the 10-year, and we're all the way up to a 375. We were as low as a 330 basically at the beginning of last week, which is a really significant move. We're seeing a really long end sell-off really start to kick in. And I think that leads us into our next piece of data, which is CPI comes out. Where do you see it, Ben? Do you think this is going to be a little bit of reacceleration? Maybe this is the first pushback against the disinflation narrative.
Yeah, I do think that there's going to be a little bit of a pickup. Maybe not an acceleration, but I do think that the movement downward has slowed for at least a little bit. Right now, the estimates are expected that the headline is going to come down to 6.2% from 6.5%, and the core is going to come down to 5.5% from 5.7%, which is nowhere near the type of declines in inflation that we were seeing previously. And so even if they come down in line with estimates, I think that will be a little bit of a negative. What Wall Street was hoping for, probably for the last until 2 weeks ago, was that you'd see inflation come down significantly faster. It looked like we were annualizing at about a 3% inflation rate over the last few months, but that does seem to be thinking like it's going to tick up a little bit. Right now, you had the upward revision for the month of December because of the lower weighting in used vehicles. And on the core basis, you're talking about 0.4, which annualizes to just over 5%. And that is the same expectation for this month as well in January. So all of a sudden we go from thinking that we're in a significantly downward trajectory and we're annualizing 3% to we're not in much of a downward trajectory and we're annualizing 5% on the core. And it also gets to the thinking of having to look at the overall trend and not just at the month-to-month data, because it can be misleading at times. Now, I do think inflation is still coming down overall. I think it's going to come down a little bit more in the second half, but I'm very curious to see what these January numbers are going to be, because we definitely had more demand in January than we had expected. I don't know, Tom, what are your thoughts?
Yeah, I think that this one's going to be a bit of a hiccup, and I think it's going to cause quite a bit of movement. And we've already seen it on the bond side. I mean, we got the University of Michigan 1-year inflation expectation on Friday, and that actually ticked up. The expectation, the survey was 4%. Their expectation is actually 4.2, which is up from the previous month of 3.9. So basically, they're saying in a year, where will inflation be? They're saying 4.2%, which is higher than the Fed's expectation by a long shot. And their 5 to 10-year inflation expectation is 2.9%. So they're still well above the 2%, mandate target as long as 5 years out. So I think that higher for longer is starting to settle in a little bit more concretely for a lot of people. I mean, it's still entirely possible we can see this number come in at expectations or even lower, but it just slows the trend quite a bit.
And that's what we have to separate, because you have the inflation piece and you have demand and you have growth. And you can have growth with decelerating inflation. That is the Goldilocks scenario. You want an improvement in growth and you want inflation to come down. So that's the Goldilocks scenario. However, there is that thinking that because demand has been higher, inflation is going to be higher as well. So just some numbers on that. I have some categories in terms of monthly card spending by household, and furniture was down 6.1% in December, up 1.1% in January. This is on a total spending basis, not inflation. Clothing down 5.6% in December, up 4.4% in January. General merchandise, so think everything that you go to Target for or Walmart, down 2.1% in December, up 5.2% in January. And then even on airlines, you're up just 0.6% in December, and it's already up 3.5% in January. So I do think that we're starting to see a pickup in inflation. I mean, even just looking at airline prices, we were talking about that before we came on the call today. Those type of services that change prices very dynamically. You're starting to see a pickup there. You're starting to see a pickup in used car values. Some of the slower things are where there's been a lot of inventory. I'm not sure if we're seeing the same pickup in inflation, but we are seeing in some pockets some pickups. And of course, the healthcare piece on the inflation print is going to be such a coin flip in terms of how that goes.
Yeah, there's no comps. It's just going to be its own thing.
So as we look for the week ahead, Tom, and maybe we'll start on the CPI. Do you think the market is appropriately priced for the CPI estimates that we talked about? Basically, CPI coming down, but not as fast as we thought it was.
Yes, I think that if it comes in significantly hotter, I think there's going to be a lot more pain. But if it comes in right above or just in line, I think that we probably won't continue to see the sell-off in bonds. We may actually see some buying. We saw, really strong demand for the 10-year auction last week at a much lower level. So I think that the move back now is anticipating a surprise to the upside, maybe not a big one. So I would say we're probably, and from my line of view, where I sit and look every day, I think we're probably priced in for a higher report. If it's very, very high, I think there's more pain. In terms of stocks, I think it's possible we could still see some more pain if we come in hot.
Speaking of stocks, we do have some earnings reports trickling in from companies that finished their quarter at the end of January. So we have Analog Devices earnings on Wednesday morning. We have Cisco earnings on Wednesday evening. Cisco will be quite interesting to evaluate, given the change in tenor from a lot of big corporations in terms of investing in their own IT or investing in web scale data centers. On Thursday, we have the producer price index, which people don't really talk about as much. Producer price index has actually been in almost deflation here. So that's good news, and that could help to quell some of the concern on the CPI. But then we have Jim Bullard, our favorite. He's coming back. He's emerging. Jay Powell took the spotlight last week. It'll be Jim Bullard this week. Tom, what are your thoughts on what he's going to say?
I think he's going to signal that we're going to have at least 2 more hikes. Whether or not he really controls that, kind of remains to be seen. I think he's had a lot of sway. He's obviously very outspoken within the Fed. But I think he's going to say it's not just 1 in pause, it's 2 in pause at the very least. Which at this point is actually modeled out in futures. We're actually at 2.46 now. So we're looking at almost 3 new hikes for this year and no cuts.
So the market's kind of priced for it.
Yeah.
Now.
I mean, it's definitely the interest rate futures are indicating that this is not fake news, that inflation has not come down to the extent that they need to, and they're going to continue to raise it. So, is it 3? Is it 4? Is it 10? It's really too early to know. If we're going at the pace of last year, we're way behind the 8 ball still in terms of what the Fed thinks they're going to do versus what they actually did. The question is, did they do enough last year that we're not going to be in that scenario again? Yeah. It's very hard to say at this point.
The Fed hiked 3 times, expected 3 hikes last year. They hiked 17 times. The Fed expects 3 hikes this year.
Yeah, we could be in for another 17. And again, I've said this all along, the risk is always going to be to the upside in rates. It's a risk for stocks. It's definitely a risk for bonds. So we just need to continue to hope for the best, but prepare for the worst. And the worst is obviously interest rates continuing to rise. And so making sure we're modulating duration on the fixed income side, making sure we're, in companies that don't have massive debt loads and are free cash flow positive on the equity side is really paramount.
All right. We'll leave it there. Big CPI report tomorrow morning. Stay tuned with us for that. Have a great rest of the day, and we'll see you tomorrow.